It was one of the worst performing sectors of 2025, but with the new Fed changes coming this year, could it finally be time for REITs to make a comeback? Joining us now with his top 7 real estate investment trust stocks for 2026 is Brad Thomas with Moat Research. You're really an expert in this field, and we're excited to bring this to our viewers. We don't talk about these stocks often, but this year they have an especially interesting story. So why don't we just start off with a look at kind of what REITs are doing this year versus what they were doing last year.
The last 2 years has been really brutal for the REIT sector. Last year REITs were the worst performing asset class overall. And even in the previous year, REITs underperformed. So really, it's been 2 years of underperformance. But I do want to say, Bridget, when we go all the way back to 2010 and 2011 and 2012, back then, REITs were one of the best performing asset classes. And the big reason for that, of course, has to do with interest rates. REITs are extremely rate sensitive. They use leverage and rely on capital markets to grow. So now that we're seeing rates decline and a new Fed chair that is going to be very pro-rate cutting, we're seeing the REIT rally finally underway in 2026.
Yeah, some of those changes are already happening, but we know more of that momentum could be coming throughout the year as that new chair comes in and as those changes start to come from the Fed. So if you're looking to invest in REITs, now feels like a better time than waiting until those changes come down the road, right?
Absolutely. And again, we're already starting to see this renaissance forming and the rates coming down. And that's really like rocket fuel or jet fuel for REITs. Now, so far this year, we've seen some really big standouts in the REIT sector. Now, of course, the great thing about REITs is that there is so many different flavors or kinds of REIT property sectors you can invest in. So some of the best sectors this year is farming. Farming's up 24% year to date. Data centers also going to be, I think, in your backyard here pretty soon as well, up 22% year to date. Net lease, which typically is a pretty boring, asset class or property sector with these long-term contractual leases, they're up 15% year to date. Self-storage up 14%. So we're starting to see within certain sectors really that lift off starting. So, but it's still, you still have time to invest in REITs. There's still plenty of value, and I'm really excited to dive into a couple of my favorite names here today.
Yes, you have a list of 7 different REITs that you are looking at in 2026. We're starting off with the first 5, which are kind of more solid companies, and we're working our way down the list to 2 of the more high growth, more speculative names in the REIT industry. So we're going to save those 2 for last. Let's get started, though. We've got 7 names to cover today. What's the first REIT you have for our audience?
Yeah, we'll try the lightning round here, Bridget. I'll try to get through these pretty quickly. But Realty Income, and you can always remember this ticker symbol is O, just one letter, ticker O. Realty Income is a net lease, which means they own freestanding properties. REIT. They have a large portfolio of over 15,500 properties in all 50 states as well as Europe. So you can see that Moat advantage forming already. That's the scale advantage in which this company generates, significant income with 1,600 individual customers in 92 different industries. So again, that's where scale comes into play. Now, those rent checks are being derived from well-known brands like 7-Eleven, Dollar General, Walgreens, and FedEx. And due to that scale advantage, they have very modest exposure to one customer. Now, another important Moat advantage for Realty Income is the fortress balance sheet. The company has an A rating from all the rating agencies. And because of these disciplined risk management practices, we believe this company can continue to generate the best-in-class earnings and dividend growth. And by the way, 27 years in a row of dividend increases throughout the global financial crisis, as well as multiple recessions. And even during COVID, the company was able to continue to grow its dividend. They're obviously a dividend aristocrat now, which is over 25 years in a row of dividend increases. This company, Realty Income, is up 17%, but I do consider the company still a buy, trading at a multiple of 15.3 times, which is below their normal valuation of around 17 times. That's the multiple we use for REITs, price to adjusted funds from operation, and the dividend yield is 4.9%. So I still believe Realty Income is a buy today.
So many good details on this first stock, and also a lot of reasons why investors are interested in investing in real estate investment trusts, because there's that dividend, the moat that you talked about, and that is why your company is called Moat Research. It makes a lot of sense because these companies have a really big moat, and it's also something you have in your most recent report. We have a QR code and a link in the comments if you want to take a look at what Brad and his team at Wide Moat Research are doing. This latest report is really interesting because it's talking about the moat with the most recent tax cuts and benefits coming from the White House. So that's also an interesting report too. You can dive into that research on your own. We'll tell you more about it later on too. But let's get to that next name on your list. This one also has a pretty good moat.
Absolutely. This one is a pretty interesting sector. I mentioned data centers earlier, and this is obviously in high demand now with all of the AI-fueled growth we're seeing, not only in the U.S., but across the world, hundreds of data centers under construction or under development. I'm going to talk today about one of the leaders in the space, and that's Equinix. Ticker is EQIX. This is, again, a leading data center landlord. They have 273 properties spread across 36 countries and 77 markets. Similar to the previous REIT I mentioned, Realty Income, Equinix has this wide moat scale advantage. So they have a number of properties. Their core business is co-location, which the company builds and operates highly secure, carrier-dense data centers. One key moat advantage is the stickiness of this platform. What that means is once a company or customers inside that data center, moving is extremely expensive and connectivity relationships are hard to replicate. That drives very strong retention and also very strong pricing power, especially in these metro markets where the company operates. The real moat is not the building, Bridget. It's the network inside of that building. Equinix has a solid report card, recently announced a 10% dividend increase along with strong AI-fueled guidance growth of 10.4% in 2026. You're going to see that demand continuing, that growth continue, rock solid balance sheet, triple B plus rating. At the end of the year, 2025, their net leverage was about 3.8 times. So very solid balance sheet. Management expects shares to grow from 8 to 10% next year and the following year. This is much higher than Realty Income, which I just mentioned. That growth there is about 3%. So data centers are certainly leaders in terms of their growth. Now, in terms of valuation, I definitely feel like Equinix is extremely cheap today. Shares are trading at 24 times their price to AFFO multiple. That's a tad below their normal multiple of about 25 or 26. Now, the dividend is lower at 2.6%, but it means it's also very well covered. So given this insatiable demand we're seeing in the data center space, Equinix remains a buy at Wide Moat as the company will likely continue to use its scale and cost of capital advantages to deliver steady, predictable growth in the future.
This is a name that is interesting to me because data centers haven't been around forever. There's not quite as much history as the company that owns 7-Elevens, which has been around for decades. How long of a history does Equinix have?
Yeah, well, I was actually kind of a first mover in the data center space. I began covering Digital Realty, that's ticker DLR, which is a direct peer to Equinix back about 2010 is when Digital Realty kind of surfaced as a REIT. Equinix was a C Corp, and then they transitioned into a REIT. And we've seen a number of data center REITs. Now, what's interesting is we've seen a lot of M&A activity. And we're going to see, by the way, continuation of that, I believe, throughout 2026. But a number of data center REITs that we used to cover, like QTS, like CyrusOne, and CoreSite, for example, or three, that are actually acquired either through private equity or REIT mergers. We don't have as many picks today. There are a couple new ones coming out. And of course, you have Iron Mountain, which is somewhat of a hybrid in terms of the data center space. But definitely, this is a sector that everyone should be investing in. And again, I think there's still plenty of room to run for these data center REITs.
Very interesting second pick on this list. Let's get to the third name that you have for us. From data centers to what next?
We're all familiar with self-storage. And again, self-storage has done pretty well this year. The dominant player in this space is Public Storage. You know, this is the self-storage franchise or chain that has these orange doors, the orange signage. Everybody's familiar with Public Storage, or most people are, because they have 3,500 properties in the U.S. They also have a 35% interest in SureGuard, which is the largest owner and operator of self-storage in Europe. So again, very large. Going back to that scale advantage, that's one of the reasons I picked these sleep well at night REITs, swans, for the top picks. They have, again, a very significant scale advantage. There are around 52,000 self-storage properties in the U.S. That's about 2 billion square feet of rentable space, and around 35% of these are owned by the self-storage REITs. Now, of that amount, 11% is owned by Public Storage. So they have really good market share. However, because of these fragmentation dynamics, Public Storage is set up to really consolidate, continue to grow their business. So you're going to see them in just about every town. If they're not in there yet, they will be there. They have the ability to grow and scale. Now, speaking of growth, they have another fortress balance sheet. A ratings from Moody's and S&P with over $1.8 billion in liquidity. After their debt, they're able to generate $650 million in retained cash flow every single year. And so we think that's going to continue to grow going forward. Another key advantage or moat of this company is their leading end-to-end digital operating platform. Technology is extremely critical in real estate and especially in self-storage. Now, this technology edge for public storage allows the company to optimize and integrate operations utilizing algorithms that enable local field decisions. I'm actually a customer of public storage myself, so I fully can understand and appreciate the technology edge that this company has. The company has returned 15% year to date. Shares aren't cheap. They're now trading at 19 times price to AFO, compared with their normal multiple of about 22 times. Growth is forecast to be modest, but as rates continue to decline, I expect 5% growth in the future, which accelerates total return prospects.
And this one is interesting to me because it feels like it would have an even bigger moat than some of the other companies because it feels recession-proof, where they hit as hard over the last 5 years or so of volatility we've seen in real estate.
Yeah, absolutely. I mean, it's a very sticky business model. I know when I have storage, it's just hard for me to leave. I just keep paying and paying and paying. Do I hoard stuff? Probably. I don't know. Maybe I do. Probably need to get rid of a lot of this stuff, but it's hard. And again, you're right. It's a very, very sticky business model.
Yeah, I think that a lot of Americans especially, but people all over the world deal with that issue. And so a very sticky business model, another really interesting REIT. Let's move on to the fourth name on the list.
So I'm going to switch over now to the residential sector and a company called Equity Lifestyle. That ticker symbol is ELS. Now, Bridget, this company is uniquely positioned to benefit from the housing market, or what I call the silver tsunami effect. Now, Equity Lifestyle has 455 properties in 35 states and Canada, and they own and operate a portfolio of manufactured housing communities and RV resorts, campgrounds, and marinas. Many of these properties are located in retirement and vacation destinations, with 110 of these properties on lakes or rivers or ocean frontage. In addition, over 70% of the manufactured housing properties are age qualified or have a resident base with an average age of 55 or over. Now, that's what I call the silver tsunami. These demographics or these tailwinds will drive the future cash flows as over 10,000 baby boomers per day are turning 65 years and older. So ELS operates in these supply-constrained markets. Again, these are mostly these states of Florida and Texas, where you've got significant retirees have moved in or migrated to those markets. And this growing demand, coupled with almost no new supply, is one strategic advantage for the company. In fact, recently, Bank of America upgraded ELS to a buy, citing stable manufactured home and RV revenue as the primary driver. This analyst said that demand for ELS's primary age-restricted manufactured housing portfolio is more driven by demographics and the migration of retirees. The customer base is less sensitive to macro volatility. Now, shares are also trading at a pretty decent valuation, and the company recently did increase its dividend by 5.3%, and they've increased that dividend for over 22 years in a row. So that's just 3 years away from being a dividend aristocrat.
This one is really interesting because it's not a company or a concept that many investors might think about. Even when you think about real estate, this would not be the first thing that comes to mind. So a unique idea, way less well-known than some of the first few names that you mentioned. So I like those. And a reminder, we do have 2 more high-risk REITs coming up at the end of our list yet, but we've got one other REIT to get to that's more of that swan, the sleep well at night REITs. What's the last one on that list, the number 5 stock?
Sure. And remember, high risk is high reward. So I'm excited to tell you about those. But now we have another boring pick, but a really solid sleep well at night swan, as we like to refer to them, EastGroup. That ticker symbol is EGP. Now, EastGroup is a warehouse REIT that owns properties in high growth growth markets and in Sunbelt states like Texas, Florida, California, Arizona, and North Carolina. They operate a little different niche within the warehouse space, more of a distribution space, or what we call flex space, where they have locations for customers that need maybe 20,000 feet to 100,000 feet, and then they want to expand. So it's a smaller footprint for those customers, but they're able to expand. Again, that's what flex space is all about. That's how it derives the name flex space. Now, like some of the other REITs I mentioned, East Group also delivered really strong results in the latest quarter. They grew their earnings or funds from operations by 8.8% and around 7.7% over the whole 2025 year. Leasing was also solid with occupancy at 96.5% and same-store NOI growth of 8.4%. So those are some very solid fundamentals. The balance sheet is also rock solid. Their debt to total market cap is just 14.7%. So very low leverage. Shares are trading at 27 times, still cheaper than the normal multiple of around 30 times. The dividend yield is 3.3%, and analysts forecast growth of 8% this year, 9% next year, that's 2027, and 10% in 2028.
Yeah, warehouses definitely seem like an interesting space right now, especially given tariffs and that kind of boosting the demand for more warehousing right in the U.S. So that REIT makes sense. It also makes sense as a sleep well at night REIT, like you mentioned. And I know that that is something that you and your team at Wide Moat Research are definitely looking at, is these companies that as investors you can count on. You don't have to deal with as much volatility. And I know that's what your most recent report is looking at too. Some of the stocks out there that are going to be solid and going to benefit from all the growth that we're seeing in the AI space. So if you want to check out Brad's most recent report, make sure to scan the QR code or click the link in the description. You can see a totally different list of stocks in this report and do a little bit more research on your own too. All right, Brad, let's get to those higher risk names. I know a lot of our viewers on this channel are used to talking about kind of high risk stocks where they might have 120% growth outlook in the next year ahead. So that's kind of more of the figures a lot of our investors have looked at on this channel. Do these two names carry some more of that kind of growth?
Yeah, absolutely. And these are definitely very cheap stocks. They've sold off dramatically, and I think there's really tremendous opportunity. We also look for the moat advantage of these companies that have underperformed as well. We like to see those catalysts and those drivers that how are these companies going to be able to dig out of the hole that they're in right now. So the first pick I want to talk about is Americold. That ticker symbol is cold. And again, shares aren't that hot right now. They've really traded down about 35%, I believe, last year in terms of their total negative return of 35% last year. Now, this company operates in a really interesting niche. It's a warehouse REIT, but really a category that we call cold storage, which means the company owns temperature-controlled logistics real estate. Now, Americold has about 230 temperature-controlled warehouses with around 1.5 billion refrigerated cubic feet of storage in North America, Europe, Asia Pacific, and South America. These mission-critical facilities are an integral component of the supply chain that connect food producers, processors, distributors, and retailers to consumers. Now, with Americold, scale is also a key advantage. It has 56 million square feet of capacity that allows the company to deploy 55 million pallet locations and over 3,000 customers. And I'm sure you'll recognize some of these primary customers in the top, say, 10 or 20. You got Walmart, ConAgra, Kraft Heinz, General Mills, and Smithfield. The top 25 customers generate around 50% of the warehouse revenues, and 13 of these are investment-grade companies. Now, another key advantage of this company is technology. The cold storage REIT utilizes its warehouse management system, or called WMS, that provides visibility to ensure orders are delivered on time and in full. They have over 415 identified Gen AI use cases, which leverages embedded AI within its tech partners. So that's another critical advantage that we're seeing not only in this REIT, but many of the other REITs that we're researching today. Now, recently, or really in December, an activist investor disclosed a stake in the company that pushed the company to, quote, review strategic alternatives. Americold has a new CEO who is looking to gain back investor support after shares returned, as I mentioned, 35% negative in 2025. Now, possible ways to unlock value include selling off some non-core properties to reduce debt, Other plans include streamlining organizational costs to optimize performance and reduce costs further. That could result in $30 million reduction in indirect costs and SG&A in 2026. The balance sheet is also in good shape, BBB rating with Fitch and Baa3 with Moody's. As of year-end 2025, liquidity was about $800 million. They have a debt of around $4 billion, backed by over $10 billion of critical cold storage infrastructure that is difficult to replicate. Shares are cheap. As I mentioned, they're trading at a ridiculous multiple of 8.9 times. Compare that to their normal multiple, Bridget, of 25.7 times, and the dividend is a juicy 7.4%. with a 65% payout ratio. So we believe the dividend is in pretty good shape. So investors can kind of wait on things going forward. We think the opportunity set is unfolding for this company to deliver extraordinary returns. Again, this is a more cyclical play. They have a lot of service. It's not just real estate. They operate a service business. But I think with this new CEO and the discipline that we're seeing so far, we believe this is a great opportunity for Americold today.
So the risk here is really in the fact that this company is on a downturn right now. They've got the new CEO, a lot of changes happening that leads to uncertainty. That's not quite as certain as the other names that you've already given. But I am curious, it's not one of those high risk up and coming industries. I mean, this is an industry that's been around forever. There's a clear demand for it. Do you ever see that demand really going away or any risk of this company not recovering?
I really don't. I mean, there's certainly risk. I mean, execution risk is probably one of the primary risks I see right now with this new CEO coming in. Most of the other REITs that we're seeing today, we're just halfway through the earnings season right now. And most of the REITs, including many of the warehouses, traditional warehouses REITs, have seen really solid results, have beat their guidance. Everybody has to eat. Think about Americold. Every time you go to the grocery store, every time you go to McDonald's, there's a very good chance that that product was at an Americold facility before it was at your grocery store.
It's a very good six pick on the list. Let's get to this last name. This is another more high-risk name right now. I'm curious to see which sector we're going to last.
Yeah, so healthcare is really an interesting space. Again, we're also riding that so-called silver tsunami wave that I mentioned earlier with Equity Lifestyle. Now, HealthPeak is really an interesting company, and they've got an interesting ticker symbol, by the way. It's DOC, D-O-C. So first off, that tells you one thing. They own medical office buildings. Everybody has to go to the doctor. I went yesterday for a little checkup, so we all have to go to the doctor at some point in time. And HealthPeak has 524 outpatient medical office buildings, or MOBs, as we like to call them. Now, they also have 115 life science properties, and I'll touch on that later, in addition to 34 senior housing properties. Now, recently, and we reported this at Moat Research, the company just announced about a month ago, they are spinning off their senior housing properties and forming a new REIT called Janus Living. Now, HealthPeak will retain substantially majority ownership in this new venture, making the remaining shares available in this IPO, which should take place I think before July of this year. The primary reason for that spinoff, based on DOC's current valuation, it isn't being rewarded for its premium housing assets. Now, again, senior housing was hot last year. I mean, Welltower outperformed all stocks. I mean, it was an amazing year for the senior housing properties. So now shares are currently trading at 8.9 times compared with 45 times with Welltower. And again, Welltower is a pure play senior housing REIT. So I definitely believe that spinoff to senior housing makes a lot of sense for HealthPeak. Now, what that leaves them with is the medical office buildings I mentioned earlier, as well as the life science portfolio. And again, that's the more riskier part of that portfolio because we've seen reduced fund flows from venture capital firms into the life science sector. We saw a pretty dramatic overbuilding of life science properties coming out of COVID. And so now we're dealing with those after effects. But I believe HealthPeak is in a perfect position to navigate through this cycle. They did see occupancy drop by around 390 basis points in the latest quarter in their life science portfolio. But the company is projecting positive growth going forward in 2026. The company's lab occupancy should pick up in the second half of this year. They have around 1.5 million square feet of leasing space in the pipeline right now. Shares in HealthPeak are trading at 8.8 times with a dividend yield of 7.3%. So you can obviously see the risk baked in here. However, I see plenty of opportunity in Healthpeak's portfolio.
Brad, you are a wealth of information. So interesting to look at this healthcare field, too. If you're interested in other healthcare stocks, one of the most interesting discussions on healthcare I've had in the last few months was with this group of 3 different experts. Make sure to watch this video next if you want to dive into more healthcare stocks and where the healthcare sector could be going in 2026.